Experts see no immediate trigger for price, suggest not to hold more than 10% in gold in total portfolio. Rally in equities takes the shine off gold investment. In news from Kolkata, an astounding bull run in the equity markets amid the pandemic has taken the shine off gold historically, one of the most in-demand assets during a crisis. Portfolio managers say there is no immediate trigger for a spike in gold prices, and the yellow metal should ideally be not more than 10% in one's investment portfolio as the economy is showing signs of recovery. Last year, when gold prices had crossed Rs 56,000 per 10 grams, investors had increased their exposure to 15 to 20% of their portfolio in anticipation that gold will cross the Rs 60,000 per 10 gram mark. But that didn't happen. Investors big and small have shown a strong risk appetite by opting for equities for the last several months despite the COVID-19 situation, betting on the country's strong growth potential. Gold was trading at Rs 47,224 per 10 grams in the spot market on Thursday, down by 1.63% from a month ago. Gold October future contract at MCX closed at Rs 47,166 per 10 grams. While there is uncertainty over the economic impact of a likely third wave of COVID-19, experts said that it is highly unlikely for Indian and global economies to slip into a recession with pace of vaccination picking up. Kishore Narne, head of commodities and currencies at Motilal Oswal, said gold acts as a hedge against inflation and therefore an exposure of 10% in a diversified investment portfolio adds value. The rally in gold is expected to come back again beginning next year, he said.